The all-share gained at 26.7% last year, which is unexpected from a market which should have been weighed down by an anemic global economy. One can argue that 2011 only yielded a return of 2.6% and that much of 2012 acted as a catch-up for local equities. So let's delve into this. What can we learn? And I suppose, Roland, let's just start off with you. And did 2012's performance take you by surprise?
I think it's taken everyone by surprise, especially given that in South Africa the economic landscape towards the end of the year was sort of deteriorating with all the labour unrest, the credit rating downgrade. So the fact that the market pulled out at the end of the year such a stellar performance surprised everyone. But the reason probably for that is the global scenario has become very positive. So a lot of global markets are running quite hard, and South Africa is highly correlated to other emerging markets and other developed markets as in the equity space, and they have followed suit. I think foreigners have had a slightly different experience than local investors. We've had a 26% return last year. Foreign investors in dollar terms had about a 21% return. But over the last 2 years, so 2011 and 2012, foreigners actually had zero return in South Africa because of currency and other factors.
So the 2 years before 2012?
No, 2011 and 2012 together basically were flat in dollar terms. So foreign investors haven't had a huge return from the equity space, but they've had some pretty good bond returns in South Africa.
And does that explain to some degree what foreigners were doing last year on the equity front, because net sellers of local equities last year?
Yeah, I mean, I think if I look at the beginning part of last year, there was lots and lots of interest in South African equities. But I mean, very specific, very specific areas, like for instance, general retailers. We're seeing those come off severely off the boil now, having had the multiples were just unsustainable at the levels at which they were. And then we kind of went into this kind of lull phase in the middle of the year where absolutely nothing happened. So you sat with returns were going slightly up and slightly down, and the Eurozone crisis was busy playing itself out. And then the American crisis continued to join the Eurozone crisis. And I continue to have investors saying to me, so when do I now invest? Is this now the right time to invest? What do I do? And then from October...
Last year, this time would have been the right time to invest. Sorry, Quibby. This time it's a bit, we're not quite sure how much further it can rally.
Well, valuations have kind of run. So, valuations have run their course now. We've sat with kind of P's at the beginning of the year last year, sitting at about 13 times, and then slowly drifting down as earnings continue to come through. And at some point, the market was starting to play catch up. And I think there's an element of that in South Africa, and there certainly is that happening globally as well. So you're sitting with equities that are quite fairly priced at this stage, and potentially even slightly on the high side. We've actually got a graph for you, and it shows the distribution here of the total returns for the JSE. Now I go back to 1960, and what I've done is I've created different buckets, and the buckets that you see right at the bottom of the screen runs down from the most terrible years you could have had on the JSE. There you can see the returns between minus 30 and minus 20%, all the way up to the most stellar years you've had on the JSE. There's 1979 at between 80 and 100%. And there you can see 2012, how 2012 kind of fits into the overall picture. Now, I mean, just to step back a little bit, there's 2011 with a return between 0 and 10%. There's 2010, 1 year just prior to that, at 10 to 20%. 2009 was a fantastic year between 30 and 40%, and there's 2008, which joins 1970 as a year that I think most investors would want to forget. So kind of in lock stock in the middle of what we kind of expect out of South African shares, maybe slightly on the high side. And if you asked us at the beginning of the year, or certainly me, I would have said to you, I wouldn't expect equities to do so fantastically well.
So if you had to look at this graph now, Roland, where would you say the market is going to be? Kind of just a general view right now and forecasting which block we're going to be in.
For 2013?
For 2013.
The situation we have at the moment is quite interesting, because in terms of growth, GDP growth, earnings growth, South Africa's in a bit of a lull. We've had some pretty bad fundamental and political news over the last 6 months. So we're not going to see the growth necessarily coming from earnings. But I still think that at least our team thinks that the market is going to do quite well, certainly not as well as last year, but certainly an average year, which is between 12 and 15% return, which is nothing to sneeze about, because of the fact that global markets are really getting a lot of wind from behind now. The US is, in terms of financial stability, looking a lot stronger. Even Europe is looking stronger. There are still some political challenges, but we are seeing a good foundation for emerging markets and for South Africa to run. So we're going to see a price the price of our market going up in terms of PE re-rating, but it's not going to come from earnings growth or from the country's generation of wealth.
It's more in the global context.
It's portfolio flows from all over that are just going to support the equity market.
Which in essence, by the way, gives us a valuation problem. Because that means valuations will have to start rising, which means if valuation starts rising, we start pushing more towards the kind of upper territories as far as valuation for the South African market goes, which means
we're slightly above average, so we're not stretched. So we could still go up to 16 PE, and 16 PE is on the expensive side, but it's not the kind of levels.
PE now at 14.
PE is now at 14, and look, it's the average is just below that, so we could still see some upside, despite the fact that we're not seeing much happening domestically, but globally things are happening.
And we've got to continue to remember that we're part of this whole BRICS thing. So, we've got a place within MSCI. We've got a place within kind of the big global indices. So, quite frankly, if you're going to be throwing money at equities and you don't want to take the risk and you're just going to buy the ETF or you're just going to track the market, South Africa will be a recipient of some of that capital. Now, how much is obviously, the question. If you've got valuation catch-up, serious valuation catch-up to play, then quite frankly, I'd argue that you'd have lots of money flowing back into the country.
Let's talk about earnings, because JSE earnings up 12.3% last year. So where does that fit into historical data?
Well, let's have a look. Have a look at the chart quickly there on your screen. That now shows you earnings. So the previous chart I showed you with total returns. That, remember, is driven by sentiment. It's your feeling about the market that drives total return. You're either going to put money into the market, driving returns up, or you're going to be taking money out of the market. But what happens in reality with markets? Well, there's two drivers, earnings and dividends. And there you can see exactly the same categories that I showed you a little bit earlier on. So the same buckets right across the screen. And there you can see where 2012 has actually ended up. You can see earnings there for 2012 up by 12%. That's obviously followed by 2011, where earnings were up there between 30 and 40%. And if you just take a step back and you go and you look at 2010, you can see a very, very similar number to how 2012 actually looked. So earnings only up by 12%, but price or total return up by 26%.
So how do you explain that?
Sentiment.
Sentiment, I agree, is part of that. But there's also an interesting dynamic that a lot of we feel a lot of professional investors are not focusing on, in the sense that everyone's looking at the economics and they're saying, last year was a great year as an example, where the economics were deteriorating, but we kept getting new highs. And people are saying, why is that happening? Well, because the markets are getting expensive. But the point we're trying to make is that markets lead the economics. So in a year's time, this time next year, you'll probably see the economics being a lot stronger than they are now, and the market is anticipating that. So if you, and this is the point I want to make, if you are a fund manager or an investor and you are focusing on the economics, you're always going to miss the run in the market, because the economics come through a year later. So we are seeing the markets telling us that the economics are going to improve.
Markets are leading indicators.
Exactly. So predicting markets is very difficult because they are the leading indicator. But the point is, if we're seeing all-time highs, it's telling us something that's going to happen. And if you're waiting to see the improvement in unemployment, inflation, interest rates, you're going to be too late.
The big issue, though, with all this is, I fully agree with what Reinhard is saying there. But the problem is that our brains are actually backward-looking. It's not forward-looking. So if you've got a backward-looking machine in your head, how do you price something forward?
And how do you sit with the newspaper and you watch Closing Bell or something, and you come and the markets hit a new record high today, and the headline is IMF cuts South Africa growth, by 0.3%. Treasury comes in with a low growth forecast for 2013. So it's hard to weigh those two up. But basically what you're saying is, remember that markets are forward-looking.
Well, remember again, I spoke to a fund manager the other day. He said to me, Kobe, if we take everything into consideration, if we sit down and we take the whole macro picture into consideration, the only thing that I really can rely on is valuation. Because what else must I rely on? I can't rely on economics alone. Yes, it's nice to know, it's decent, it's decent to at least model around those things, but valuation is your friend, because you've always got a margin of safety that you could build in with valuation.
Let's talk about dividends, because dividends were also your friends in 2012.
Yeah, and this is now this is now very interesting. And the fact is, earnings are up by 12%, but dividends were up by 31.6%. So companies shared a lot more dividends than that they did actually in previous years. Let me show you what a graph looks like as far as dividend flow is concerned. The first thing I want to show to you is, look at how often companies share dividends with you, and where dividend growth is up between 0 and 10%. Almost Almost always. That's since 1960, which means the way in which we treat these companies and how they treat us are sometimes quite different. We're happy to sell the share, but quite frankly, they're quite happy just to carry on paying us a dividend. Now, let's have a look at those 2012 numbers. I want to show you what those look like. There's 2012 growth. Between 30 and 40%. It joins the rest of the years there, 1973, 74, 2001, 05, 07, 2011, and 2012. Massive dividend growth. And I'd probably say, Roland, I don't know if you'd agree with that, but that dividend increases will probably start petering out towards in this year.
Yeah, look, what we have is, again, a global backdrop where a lot of companies are sitting on, huge amounts of cash. They are reluctant to take risk in this kind of environment. There's so much political uncertainty. So what do they do with that money? They give it back to investors as dividends. And that's actually a great kind of environment to be in equities as well. And certainly my colleagues at Barclays globally are calling equities the new bonds. In other words, you are getting reliable dividend coupon returns on your investments, which you're not getting necessarily from bonds anymore, and bonds have run so hard, and there's this big bubble literally waiting.
And that's what the view is right now at Absa.
Yes, the valuations in bonds domestically and internationally are very, very stretched, but equities are actually paying you a very good above inflation return via dividends. And with 30 to 40% dividends, those kind of companies, and that's not certainly all equities.
Yeah, that's what I was going to say. Who's paying the dividends?
It's the high dividend, high cash flow generating companies that are really where you want to be in uncertain times. Now, we're moving out of uncertain times, so I would agree with you that over the next year, that will probably come off because businesses will start using that cash to grow their business rather than to paying shareholders a return.
You talked about the bond market and talked about stretched valuations, and everyone's, that is the question this year, as it was last year this time. But talking about bond yields, give us a kind of picture of where bond yields in South Africa are relative to equity yields and, of course, cash yields.
Yeah, I mean, if you look at, if you just have a look at the yield spectrum that you're picking up in South Africa, divvy yields are running at about 3%. Bond yields are running up at about 8% as far as your bond yields are concerned. So if you just have a look at those two, I mean, there's a kind of a mismatch between those two. And as a matter of fact, quite frankly, the yields for bonds will have to start rising at some point, and you're going to get price pressure as far as that is concerned. Now, that is certainly the case that you're seeing globally, but it's a reverse of that. So you're seeing dividend yields that are actually beyond where you're actually seeing bond yields, which is completely the other way around. And that's what now Ronald was talking about. He was saying, well, quite frankly, you can buy these dividend machines globally. Why not buy those?
What's the case for buying bonds, though, still in 2013?
I don't know if there's a case for buying bonds.
Is there? And what are the risks? I mean, what is going to drive bonds, if anything is going to drive
Unless you want to slightly diversify, Ronald.
The big risk with bonds at the moment is the currency. And I think most people would say that bonds in South Africa are very stretched. So I don't think you're going to see we certainly don't think you're going to see very strong returns from bonds. And we're quite poised at a sort of tipping point now because we've had sort of blowouts in the rand, sort of mini blowouts, and that has contributed to a lot of nervousness from foreign investors. They have been the biggest buyers of our bonds over time, and since January we've seen some serious selling in terms of the flows from bonds. So the buyers have turned to sellers, and this is big money. So that could make the rand weaken further. So foreigners, at least the ones we speak to, are saying they are worried about a weakening currency, which will create higher inflation in South Africa, which will make yields go up. And that will depress bond returns. So it's actually very timeous now to consider downweighting a bond allocation.
Let's come back to the South African market. I want to show some price to earnings ratios, and I just want to show you what the history kind of looks as far as price to earnings ratios are concerned. Just look quickly at that graph there. There's the Aussie PE, and I go back to 1960, and I show you what the price to earnings ratio looks like for the South African market over time. Now, obviously, the most advantageous times to have bought this market, obviously, is when price to earnings ratios are right at the bottom end of the screen. So they kind of touch against the 8 and 7 PEs for the whole market. What you're seeing at the moment is kind of long-term average, maybe just slightly ahead of long-term average at about a 14 PE. What does that historically mean for returns? Well, what I'm showing you over here is the correlation between price to earnings ratios, or the starting price to earnings ratios for the market, and your subsequent 5-year return that you could be making out of equities. And this is now obviously in real terms. So if I just take at the moment, equities are trading between a 13 and 15 PE, which means on average, on real terms, market trades at about 8%. We'll give you on a 5-year basis, about an 8% return. It could be fantastic if we get earnings growth or more kind of, reversion to means as earnings grow. That'll push up returns all the way up to 20%. But quite frankly, you can lose some money as well. It's not a foregone conclusion you're going to be making out of money out of markets from this point.
So then what is the risk of getting into equities now and losing money? I mean, is there a risk on a short-term basis?
There's absolutely a risk. I mean, the big risk right now is that the global recovery in equity markets splatters a bit. We've had strong returns from the US and from Europe over the last 6 months. If that tapers off, we are again a high beta play on that. So any sell-off in equity markets globally will be a bigger sell-off in our markets. But at the moment, we're not seeing that.
Mm-hmm. Yeah, allocate sparingly to equities. Absolutely.
And choose the high quality kind of dividend yield,
with
cash flow kind of stocks that will give you that return above inflation, or at least matching inflation going forward.
Mm-hmm. I think markets from these levels have to either peter out slightly or come back slightly in order to kind of come back to kind of long-term average valuations. And I mean, that means allocate capital sparingly, sit with cash. There's going to be more opportunity at some point.